So we've been working on a strategy that follows the trend. But what if you want to create a strategy that works counter-trend, or that works during a consolidating market? Let's see how we would approach creating these strategies in the differing market conditions. While we previously used moving averages and trend line bounces to create a trend-based strategy, for a counter-trend-based strategy, we'll observe reversals to find patterns that may indicate a reversal is coming. Once we've found repeating and consistent patterns between several reversals, we'll then create rules and entry reasons around these patterns to form our strategy. Then we'll begin backtesting. For consolidation-based strategies, once we've defined that we are actually in a period of consolidation, we'll mark out our channel of consolidation. Then, much like the counter-trend approach, we'll observe the reversals at the edges of the channel and analyze them for repeating patterns or signals. We may want to straddle multiple timeframes in these strategies to capitalize on the limited range of movement in a consolidating or range-bound market. Every trend must come to an end, and when it does, the market will either be consolidating or it will be reversing. So, to identify reversals, I begin by looking at the daily chart and looking for a major point of reversal. I'll then zoom into this area and drop down 1 or 2 timeframes to look for any obvious patterns. These patterns can include RSI movements, candlestick patterns, or interactions with other indicators. So we have a major reversal here on September 28th. So I'm going to replay the market to this big green candle, and we're going to zoom in and look at the 4-hour chart. We can see we're going to push down here. We've got a little bit of smaller candles before this big push up. Now I'll actually play the market forward a little bit just so we can see what happened after it. So we can look for a few things here. We could wait for the market to push up and make a new high on this time frame on the 4-hour chart above the 50 EMA and then bounce off that. That could be one of our indications. We could look at this kind of pattern here where the market moves lower, creates some highs, creates a pullback and pushes higher again. Maybe the breakthrough of there is where we start to look for going long. Also, we can see here that the RSI is very oversold. It's down to 15 here. And as the market pushes back, then continues lower than that previous candle, we actually have a higher RSI at 28. Now that is a thing called divergence. When the market moves lower, but the RSI moves back as a kind of corrective stage, and that is a good indicator that the market is reversing. So if we're to look for this pattern and we see that there is a little bit of divergence as well as maybe a break and a bounce of the 50 EMA, that could be a good entry signal on this 4-hour chart. Additionally, we can drop down to the 1-hour chart and see if we can notice any of the same sort of things. We can see we were oversold here, and then the market pulled back and moved further below there without becoming oversold and bouncing back up. So once again, we have divergence. We have a big push up here and a pullback. And once again, we have a bounce off the 50 EMA, this time on the 1-hour chart as well. So that's a good indicator that the market is pushing upward. So let's move over to a different reversal on a different chart altogether. And we can see there is this one on the New Zealand dollar, US dollar. So if I'm starting on the daily chart, I'm going to drop down to my 4-hour chart and see if I can find anything here. We don't quite have the same level of divergence. We have a little bit here. Depends if you can call that the same sort of thing. But let's look down at the 1-hour chart as well. So here we have quite a high RSI above 80. We get push up again and we have a lower RSI. So once again, another great example of divergence happening there between those peaks and those peaks before the market pushed down. So we could look for divergence as well as a push down and a break of that 50 EMA. And on the close of that candle, we could short the market and watch as our market moves downward. Now to formulate a strategy from this, we will need to observe these on multiple reversals and compare the likelihood of each of these factors and how much they influence the reversal. Expanding on that point from reversals, we don't always need to trade in the same time frame. We can get our structure points from a larger time frame and take the trades on a smaller time frame once we have confirmation. So this could be particularly useful when we're in consolidation. If we revisit this chart of consolidation from the previous lessons and we replay the market to see our bounce off the top here. If we drop down maybe 1 time frame or perhaps 2 time frames down to the 15-minute chart, we can look out for anything that may be catching our eye in here. You can see we're getting a bounce out. We get a bounce back into it as well. So we can see we're bouncing off the 50-period EMA. We bounce back into it. We break and close below the 50-period moving average. Then we actually get a bounce off it there, as well as another bounce as well. Now we can see the market has moved into this upper band here, and we're going to look for the market to give us evidence that it's going to push lower. So we could take this bounce here and the bounce out of the consolidation zone as a signal, or maybe it's when it breaks through the 50-period moving average, pulls back to it and bounces off. You can see it's done that twice in a row. Those are all valid points we can start looking at. So if we move forward and look at the point where it breaks to the bottom, here we are, we've got our bounce out of the lower region. So if I'm to drop down to the 15-minute chart again, you can see we get a push into there. We get another visit as well. Here we are, we have a breakout and a bounce out just like the other time. And that is also on the other side of the 50-period moving average. So we could be looking at a bounce out of the zone with a revisit and a bounce straight out of it, a 2-candle move there. Or we could wait for the push and the pull back to the moving average, which is kind of our moving support and resistance line, before moving upward. Now that ticks off 2 of the things that were in the previous zone up here at the top. That is the same sort of mirror image, and that is also a bounce off the area as well. So any of those could be signals of the market pushing back down. We're just going to need to make sure it happens in each of them. Let's move the market forward again. Consistency. So as we zoom in, we can see there's this big sudden push right up, breaking through the zone before revisiting it, and then it pushes out down below. So this would have been an area of uncertainty, but we're just looking for confirmation that will move lower. So it depends if we use this little revisit here and this breakout below as any indication, or if we need that pullback on the trend side of the 50 EMA to ensure that we are moving down, or if we need to bounce out of it. This is displaying all those options as well before the market continues along and pushes back down to the other side. Now we get another revisit. Let's drop down again. What are we on the 15-minute chart here? We can see we get a push out. Once again, we bounce back into it and we push up here before coming back down. We get a little bit of activity around the 50 EMA here, and then we get our push upwards. By marking our structure zones on larger time frames and moving down to smaller time frames to look for trades, we're able to capitalize more on smaller market movements. You can see how effective multi-time frame trading could be with consolidation-based zones or even with support and resistance zones. You can also utilize it for your reversals and trend-based strategies as well, as long as you have solid rules outlining your strategy. When we have a market in trend, the high and low points can be considered moving support and resistance areas. As such, if I mark these levels, we may see the market return to these areas during pullbacks, making them great areas to place trades from. So I'm going to look at the candles that are the swing low of the trend before the pullback. So in this point, the low being here, I'm going to take the wick as well as the body and draw out a rectangle there. So we can see the market pushes down. I'll take this low as well, put that around that body. We can see the market pushes down and pushes back into this area, holding resistance there and pushing down. We break through this area, we come back into it with a little break above actually before moving down. Let's put another one on this candle here and include the body again. And if we move across here, we can see we get a break out of that region before pulling into it and pushing back down again. Now let's take this low and we can see we break through and get a nice pullback into there as well with rejection pushing down. And I'll take the next candle here, which will be this one here. And we can see there's a little bit of consolidation around this point. We even get a pullback into this region here before pushing back down and touching it again before bouncing off. Now it looks as though the market is turning around here, so we'll flip direction and start putting these on the top of the candles. So you can see I'm putting my rectangle around this red candle here, being that it's the swing candle and it's got the closest body. It doesn't need to be a specific green or red candle depending on the direction. Just the swing candle with the first body will be enough. So now we get this push up, a break, and pull back down into it. I'll draw the next one as well, seeing as we've got quite a pullback there. It'll be this swing high to that body. And we don't really have so much action in there, but let's take the next one. Swing high to the first body. And we get some wicks in here as well, showing rejection. Okay, let's push up. Let's go to the next one. There is our swing high and our first body. And we get a nice pullback into this region before a bounce up and returning to that region before pushing up again. You can see how these levels can enhance a trend-based strategy. Now that we've had a look over those, let's get back to our 35 bounce strategy.